अच्छा जी, welcome back and welcome back. And this is part two of our chapter on stock valuation. So in this chapter, we shall continue our discussion. In the previous part, in the first part, we discussed about the basic facts of these stocks. So in this second part, we are going to discuss some more concepts related to the stocks and related to the stock markets. So first of all, if you see, it is mentioned over here the primary stock and the secondary stock, primary stock market and the secondary stock market, primary market and the secondary market. So let's discuss the difference between two first. What is primary market and what is secondary market. So see, let me give you a theoretical, hypothetical example for that to explain these two concepts in the primary market and the secondary market. Uh, Primary market, it is mentioned over here, place where the sale of new stock first occurs. For the first time, I have developed a company. All right, I have developed a company, and I'm in need of capital. So I'm in need of financial capital. For that, I have decided to sell my shares. I have decided not to borrow money. Instead, I have decided to sell my shares and then to sell shares of my company. So what I will do, I'm going to offer the sale of my share to public, to different people, to common people, to public. So this is the first time I'm going to offer to sell my shares to a common person, or to different shareholders, financial institutions. So this happens for the first time. So that is why it is mentioned over here. Sale of new stock first occurs for the first time. You are selling the shares of your stock. So that transaction, so I'm for instance, I've advertised on a daily newspaper that this is my company, and this is what we do, and we are interested, we are in need of financial capital, and we have decided we are interested in to sell the shares of our company. So whoever is interested, please submit your form and submit your amount. So we'll be giving you our shares again, and you are supposed to pay us for those shares. So then you'll become our partner. You'll become the owner, proportionate owner of our organization. So this is the first time I'm selling shares of my company. So, and you are, for instance, you are going to buy my shares. So this transaction, which is taking between myself as being a company and yourself being a new shareholder. So this transaction that is taking place between us, it is known as primary market. It is known as primary market, that a company is selling its shares for the first time to new shareholders. So this operation is known as the primary market. This transaction takes place in a primary market. All right. So, okay. So for instance, you have purchased my share. You have purchased, for instance, 500 shares of my company, and you have paid me that paid me the amount for that, and you have purchased my shares. Now you are the shareholder, and you are the proportional owner. But on some other day, you have decided to sell my shares. You are no longer interested in to keep my shares, and you want to sell my shares for any purpose. You want to sell my shares and buy the shares of any other company, or you want your money back, or whatever could be the reason. So but the point is, the bottom line is that you have decided not to hold my shares anymore, and you have decided to sell, to dispose those shares. So you go to a stock market of a country, and where your company is listed. So you go to a stock market, for example, you purchase a share of Lucky Cement. So the Lucky Cement is listed in Pakistan stock market. So you go to Pakistan stock market physically, or have your virtual account over there, online account with any broker of a stock market, and just go and log in your account, and your shares would be representing over there, and there would be an option for you to sell your shares. So you decide to sell your shares. So you have sold your shares, so some other party, some third party have purchased your shares. So that transaction which is being taking place between yourself as a being a first shareholder, and the third party, and a new person being a new shareholder, so that transaction between yourself and the third party is taking place between secondary market. That is taking place between secondary market. So when the share is sold for the first time by a company to any person, that is primary market. And and when that person who has already purchased a share from a company is decided to sell the share to any other person, so that sale purchase is taking place in secondary market. So if you see over here, it is mentioned it's a second market in which already issued securities are traded by investors. So company has already issued its securities, company has already issued its shares and sold its shares. Now the shareholders, the existing shareholders, are selling their shares to any other person, so or any other company. So that is basically an operation of secondary market in a stock market of any country. So every day it happens, it takes place every day, all the day, from morning until evening, that different people who own shares of different companies, they sell the shares, their share to someone, and then they buy shares of some other company. So buying and selling take place all the day in any particular stock market. So this all those operations are basically secondary stock market, because all those shareholders have already purchased someday those shares from a company. So that was the primary market. But now what is taking place from morning until evening, it is secondary market. You may say, you may call that stock market of a country is basically a secondary market, where already purchased securities, already purchased shares from a company are sold to each other. All right. I hope you must have clear with the concept of primary market and the secondary market. Primary market is basically the sale of a share for the first time, and the secondary market is basically the sale of a share for the second, third, fourth time, not first time, then whatever time it could be, second time, third time, fourth time, fifth time, 10th time, 20th time, 30th time. All obviously a share was sold by a company 10 years back. So during and now, since those 10 since last 10 years, so all those during all those 10 years, those shares must have been sold or purchased by different people. Some must have sold them, others must have purchased them, then those others must have sold to some others, and so on. So this process keeps continue. So this is the operation of secondary market. All right. The another thing which is mentioned over in this slide is in between these two markets is IPO. I stands for initial, P stands for public, and O stands for offering. IPO means initial public offering. So it is mentioned with this is first offering of stock to the general public. See, we just discussed about the primary market. So where we discussed primary market is stocks are sold for the first time. So this process of selling stock for the first time, it takes place through a process which is known as IPO. I have a company, I own a company, I am selling my shares for the first time. So this the sale of this share in these shares for the first time would be known as the primary market. But this sale takes place with a process, and that process is known as IPO, initial public offering. I own a company, Aminullah Sheikh Private Limited. All right. So I'm selling the shares of this company. So for the first time, so this is the primary market operation. But how would this operation be executed? So that is executed with a process, and that process is known as initial public offering. So I'm going to explain this entire process in front of you, how this process basically practically takes place. Initial public offering. This is the initial because this the first time shares are sold. This is initial. All right, shares are sold for the first time. This is initial. Then public. Why it is public over is the word of public is there. Reason being, these shares which are sold for the first time, they are sold to the public. They are offered to purchase to a common people, to a general public. So as I discussed previously, so these shares are sold through a newspaper advertisement. So that advertisement is responding, is addressing to the general public. So general public are offered to come and buy our shares. So that is why the word general is public is mentioned over here, the initial public. All right. This is initial public because shares are being sold to the public. So initial public offering is self-explanatory, that we are offering general public to come. Why don't you come and buy our shares? Okay. So the abbreviation is IPO. It is mentioned with this is first offering of stock to the general public. So how this process takes place, so let me explain it with you. Since you have been discussing, you have been studying stocks for the first time in your life, so you must be knowing what is IPO and how this process takes place. So that if you come across with any IPO in your life, so you must be knowing the concept. Okay. So let me give you an example. Let me explain this entire process with an example. uh, there's a new company. Okay. So for instance, there's a new company, Hafsa Private Limited. Okay. So Hafsa Private Limited has decided to go to public and generate financial resources, generate financial capital. So and they have decided to sell their shares. Hafsa has decided to sell its shares, sell the shares of its company to general public. So what they will do, they are going to develop a registrar office first. So Hafsa Private Limited is going to develop a registrar office. That registrar office will be working as an intermediary, working as a middleman between middle company between Hafsa Private Limited and general public who are interested in to buy shares of Hafsa. All right. So what happens? Can has initially Hafsa has developed a registrar office, and that the task for that registrar office to advertise in the sale of shares of at Hafsa Private Limited to the general public. So they'll be putting some advertisement on a newspaper, and they will also be developing a prospectus of Hafsa Private Limited, and that prospectus would be listing that what is Hafsa Private Limited, what is their vision, what is their mission, what is their objective of an organization, of a business, and what are they expecting in future, okay, how this business will continue, will go on, and why they are interested in, why they are in need of financial capital, what will they do with that amount of capital which they are going to raise through sale of shares. So where that capital will be utilized, and what returns, what profits are expected against those investments and against those capital. So all those details are mentioned in a prospectus. It is as same as you are interested into buy into get an admission of a university. So the university gives you its prospectus. That prospectus that prospectus lists all the vision and mission of a university, the programs they offer, and the facilities they offer to the students, and etc etc. So basically by prospectus, a university is targeting, or a university is talking to its potential students who are interested in admissions. Similarly, an organization, Hafsa Private Limited, is interested in financial capital by a public. So they basically target the public. For them, they develop their prospectus, and that prospectus mentions all the details related to the Hafsa Private Limited. All right. So we were talking about the registrar office of AFSA Private Limited. So that registrar office will be that registrar office will be advertising in the sale of share of AFSA Private Limited. They'll be sharing prospectus with potential shareholders, and they'll be announcing some dates to subscribe for shares of AFSA Private Limited. For example, today is, for instance, today is. You may call it today is 20th of April. 20th of April. Na? So today the registrar office will advertise that for next 15 days you have an option. We offer you to come forward and subscribe for shares of Hafsa Private Limited. So they are giving 15 days to common people. So they keep their applications in their submission as a subscription applications with different banks, and people approach those banks. They get the forms free of cost, and they fill the form. All those who are interested, they fill the form, and along with an amount required, along with a check or pay order of an amount required, they submit that application. For example, there is an application of Hafsa Private Limited, and the subscription amount is, for instance, 15,000 for 500 shares. So if you are interested, you may fill the form and submit the form with a check in the favor of Hafsa Private Limited. The amount of the check would be 15,000 rupees. Okay. So all those people who are interested in the shares of Hafsa Private Limited, they'll be filling and submitting the application form with the bank, along with their checks, and then if there are more applications than the required subscriptions, there will be a like lucky draw. The registrar office of Hafsa Private Limited, they'll be conducting a lucky draw, and all successful applications will be allocated shares, and their amount will be forfeited. However, if there are people who are unsuccessful in the lucky draw, so their amount will be refunded within a week or two times. Their amount will be refunded, their applications will be rejected, and other people who were successful in the lucky draw, so their amount will be given to the company Hafsa Private Limited, and against that amount, Hafsa Private Limited, the shares of Hafsa Private Limited will be given electronically to all the buyers. All right. So this is the process of IPO. This is how IPO takes place through a registered office of a company. So the registered office basically works as a middle company between a company who is interested in to sell the shares, and the common people who are interested in to buy the shares. All right. So this is the process of IPO. So we are done with this slide. Basically, we are done with the primary market, we are done with the secondary market, and we have also done with the initial public offering. Moving forward in the next to the next slide. Acha ji. This is stocks and common stock. So for stocks, we normally have two types: the common stock and the preferred stock. For stocks, we normally have two types: common stock and the profit and the preferred stock. All right, hang on a minute, please. Let me drink a glass of water, and then we will resume. Give me a couple of minutes, please. Acha ji. So let's resume. So we were talking about, we discussed the primary market, we discussed the secondary market, and we discussed the IPO, the process of IPO. Next is, I was discussing about the two types of stocks, the common stocks and the preferred stocks. The common stock is ownership shares shares in a publicly held corporation. So the common stock, you may understand it better in a comparative way. We have common stock and we have preferred stock. In common stock, we do not have any preference. In preferred stock, we have preference. So which preference are we talking about? So there are basically two main preferences which are given to preferred stockholders, not common stockholders. The first one is, in preferred stock, you get a predetermined amount of dividend. So in preferred stock, if you are buying if you are getting a chance to buy a share of a preferred stock of any company, so you will be knowing your dividend amount on the day one, that what dividend amount you'll be getting at the end of the year. So very first day, at the time of buying a share, it is mentioned on a share, okay, what would be the amount of dividend on that share, what would be the percentage of dividend on that share. So for the first day, you get your amount, you know your amount. So what return you will be getting out of it. So whereas in common stock, you are completely blind, and you do not know what dividend you will be getting, more dividend or less dividend, or no dividend or zero dividend, or loss, or whatever. So whatever would be the situation by year end, you do not know it in advance. However, in preferred stock, you know that in advance, that what amount of dividend you will be getting at the end of the year. So this is the first difference between primary stock, preferred stock, and a common stock. And I hope you might have realized that, you must have realized that the preferred stock is very similar to the bonds. We discussed at the start of this chapter is, bonds are fixed income securities. Similarly, preferred stocks are also fixed income securities. They are shares. Now you are becoming the shareholder of a holder of an organization. But the point is, they also entail, they also carry the fixed amount of dividend. For example, I have a company, you are buying a share of my company, you are buying a share of preferred stock of my company. So I'll be letting you know on the day, on the very first day, when you would be buying the share of my preferred stock, and that how much return, how much dividend return I'll be giving you at the end of the year, irrespective of my company performance. That the promised return will be given to you by year end. So this is the first preference. This is the first difference between common stock and a preferred stock. There is one another difference, which is again very important. In preferred stock, you get arrears, whereas in common stock, you do not get arrears. Arrears means, for instance, you buy a share of preferred stock in year 2021. All right, in 2021, you buy a share of a preferred stock of a company. At the end of 2021, you are expecting dividends. But for instance, a company is in shortage of cash, a company is in losses, or a company is in profits, but they are interested into reinvest their profits in a business, and so they are not giving any dividends, they are not giving full dividends, they are giving partial dividends, and rest of the amounts are decided to be invested back in a company. So in 2021, either you have not received your dividend which was promised, or you have received that in partial. So what will happen in the next day, in the next year, 2022, when a company is distributing its dividends for 2022, so the preferred stockholders will be getting the dividend of 2021 as well, or in full, or whatever amount was left. So in 2022, you'll be getting the dividend of 2021 as well, if it was not paid in 2021. So you are getting arrears. This means arrears. However, in the case of common stockholders, if they did not receive dividends in 2021, so in 2022, they will no longer be receiving the dividend of the preceding year. So if you did not receive received the dividend of 2021, so it is gone. So you are not entitled, it will not be noted as you have not received the dividend for this year, so this will be paid in the next year. This is not the case with the common stockholders, so they do not get arrears. However, the preferred stockholders get arrears. So this is the difference between common stock and the preferred stock. So we are done with the first concept, the concept common stock. The next is dividend. The next is dividend. It is mentioned over here, periodic cash distribution from the firm to the stockholders. Periodic means regular. Okay, regular cash distribution from a firm to the stockholders. Let me explain, let me put it in an easier way in front of you, that whatever amount of profit you get against your shares, this is known as dividend professionally in a business language. The profit of shares is known as dividend. You have purchased 500 shares of Lucky Cement, and at the end of year you have received a profit of, for instance, make it simple, for profit of 5,000. So that 5,000 amount is known as dividend. So the profit on shares, the profit on stocks is known as dividend in a business language. All right. So obviously it means when you buy a shares, you expect dividends. You are interested in dividends. You want to earn dividends. All right. You might have heard by different people, this company has paid a dividend of 10%. This company pays good dividend. The dividends of this company are not good. This company has not paid dividends for last 4 years, 5 years. So this is what, the same thing we are talking about. The dividend means the company, which company pays at the end of the year, or at the time of distribution of the profit. So the profit on shares is known as dividend. All right. Next, we have PE ratio. PE ratio. P stands for price, not Pakistan. P stands for price, and E stands for earnings. E for elephant. E stands for earnings. So P means price. E means earnings. PE ratio means price earning ratio. Price, please try to focus, try to realize, okay, what we are talking about. We are talking about price, and we are talking about earnings of an organization. So in this ratio, we calculate this ratio to relate the price of a stock with the earnings of a stock, earnings of a company. You own a share, you own a price, you own a share of Lucky Cement, so there would be some earnings of Lucky Cement by year end. So you are going to compare the price of your share, which is prevailing in the market right now. So you are comparing that price with the year end earning of the company. So you want to see what you are looking for. You want to see what is the relationship between price and earning. If price is going up, whether earning is going up, or if price is going down, whether earning is also going down. So how these two factors, price and earnings, are related with each other. See, try to be logical. See, when you buy a share, so you are interested in two things. Number one, the price. You purchase a share on rupees 400, so you would be interested that the price should go up and up, so that it will give you a capital gain, it will give you a benefit at the time of sale of that share. So you are interested in price. Similarly, you are also interested in dividend. So it means you are interested in dividend. It means you are interested in the net income, then in the earnings of an organization. If an organization is earning more, so they'll be giving more dividend. If they are earning less, so they'll be giving lesser dividend. So you are also interested in the earnings of an organization. So by purchasing a share, you normally have two expectations. Number one, higher price, and number two, higher earnings. So these are your two expectations. So in this PE ratio, you compare these two, P price with earnings. So how the formula is mentioned in front of it is price per share divided by earnings per share. take the price per share and take the earnings per share, divide the total earning of an organization against total shares, total outstanding shares, so you will be getting earning per shares. Earning per shares, in short, it is known as EPS. EPS, earning per share. So price per share, take a price per share, take divide the price, divide the price of an organization with total shares outstanding. So you'll be getting price per share. So price per share divided by earning per share. So you get an answer. So that answer gives you the relationship between price divided by earnings. For instance, let me put it in front of you. Sorry. P E ratio 1.3. All right. For instance, you calculate your price PE ratio, price per share divided by earning per share. You get the answer as 1.3. So what that answer 1.3 reflects? It says that the price of a company, the price of a share of a company is 30% or 30% higher than the earning of that company. You are comparing the price of a share of Lucky Cement with the earnings of Lucky Cement. So you are comparing the price of Lucky Cement with the earnings of Lucky Cement. The answer comes as 1.3. That means the price is higher than the earnings by 30%. To 1.3, 30%. It is higher than the 30%. All right. For instance, price is, you may call it like this na, earning per share is 1, price per share is 1.3. So 1 and 1 are equal. So price per share is 30.30 times more. PE ratio means price against earnings. So if an answer is in positive more than 1, so it means price is higher than the earnings in terms of per share. And if the answer comes below 1, for instance, your answer comes as 0.8, price per share comes as 0.8. It means earning per share is 1, your price per share is zero point 0.8. So zero point 0.8 is lesser than zero point 0.1 by 0.20 times, by 20%. So your price per share is coming as 20% lesser than the earning per share. So this is how we can relate PE ratio, price per share with earning per share. All right, so this ratio is very pertinent and at the time of discussion of stocks. All right, moving forward to the next slide. In the next slide, we have preferred stock. We have already discussed that, so I will not repeat it. A preferred stock is a type of stock that promises a fixed dividend, but at the discretion of the board of directors. So it means you get the fixed dividend. Your dividend is predetermined, pre-decided, but whether you will get it this year or not, so that is decided by board of directors. If they decide not to give dividend this year and reinvest the amount in the business, so you will not be getting it, but it will be recorded as payable to you, that the company is liable to pay you this dividend which they have not given this year, sometime in future. All right, so you ultimately you will be getting your dividend. Preferred stock has preference over common stock in the payment of dividends and claims on assets. It means you will be, the preferred stockholders will be getting dividends first, and then common stockholders will be given dividend if amount is left. So they are, common stockholders are given dividends after once it is given to the preferred stock. Similarly, claims on assets. It means if a company is going bankrupt, it is selling its assets. So the amounts will be paid to preferred stockholders first, and the common stockholders later on. So first, the claims first, the amounts of preferred stockholders will be returned, and after that, whatever is left will be distributed among common stockholders. All right. Moving forward, the next slide: book value, liquidation value, and market value balance sheet. Book value, liquidation value, and market value balance sheet. What is book value? It says net worth of the firm according to the balance sheet. Net worth of the firm according to a balance sheet. You are talking about the balance sheet. You are the shareholder of a balance sheet. Take the balance sheet. Sorry, you are a shareholder of a Lucky Cement. All right, you are a shareholder of a Lucky Cement. So take the balance sheet of a Lucky Cement and look at the footing of balance sheet. By footing, I mean the last figure of total assets figure of balance sheet. So whatever is that figure, whatever is that value, that is the book value of an organization. For instance, talking about Lucky Cement must be having some current assets, some fixed assets. They'll be having some current liabilities, long-term liabilities, and shareholders' equity. So whatever is the final amount of their balance sheet, for instance, the final amount of their balance sheet is 1.2 billion rupees. 1.2 billion rupees. So you may call, you may say the book value of balance sheet is 1.2 billion if Lucky Cement is sold today. So if it is sold today, so in terms of books, in terms of financial statements, in terms of the balance, whatever balance sheet is saying, Lucky Cement will be sold on 1.2 billion rupees. So if we take and the values of balance sheet, so according to the books, according to theoretically किताबों को देखें अगर तो Lucky Cement will be sold on 1.2 billion rupees. However, in contrast to the book value, we have market value balance sheet, the last figure mentioned over here, the market value balance sheet. So the market value is normally the higher than the book value. So as in the previous example, the book value of balance sheet of the book value of Lucky Cement is 1.2 billion. But in practically when the Lucky Cement is available to be sold, so their value will be higher than their book value because of goodwill, because of reputation of Lucky Cement. Today, like everyone knows Lucky Cement, all the customers approach Lucky Cement. So this is the reputation, the goodwill where Lucky Cement has earned. So the market value would be on whatever amount the market value would be. It is mentioned over here for the financial statements that uses market value of assets and liabilities. Take the market value of your assets, take the market value of your liabilities, so you will be getting the market value of your balance sheet. For example, in your balance sheet, you have a car, you have a vehicle which you purchased, for instance, 3 years back on 5 million rupees. You invested 5 million rupees to buy a car, but after some time but on today, after 3 years, for instance, so after 3 years, so if you sell that vehicle, it will be sold on higher prices. You bought it on 5 million, but it will be sold on 6 million, 6.5 million probably. So that higher value would be the market value. It could also be possible that it is sold for the lesser value. That the point is, you bought it on 5 million, but today the market has depreciated very sharply, and so the point is, you are selling it on 7 million. So you bought it 5 million, it was your its book value, but you have sold it on 7 million. The 7 million is your market value. Market value is what you would be getting from the market by sale of your assets. All right. So this is market value. Then in between market book value and the market value, we have one more value which is known as the liquidation value. Liquidation value. In liquidation value, it is mentioned over here, net proceeds that would be realized by selling the firm's assets and paying off its creditors. For instance, let me give you an example. Let me put it over here. Um, what am I doing? See, I have put three values in front of you. 1.2 billion for market book value, 1.4 billion for liquidation value, and a and 1.9 billion for market value. See, your balance sheet says the worth of your company, the value of your company is as 1.2 billion. But as per the market value, market estimates, it says the value of your company, the value of your assets of your company is 1.9 billion. But when you come to to sell it, and you get a buyer, so there's a negotiation between yourself and a buyer, and the final price was decided was for 1.4 billion. So the buyer has agreed to buy your company on 1.4 billion, and you have also agreed, you have given your consent that 1.4 billion is fine. So that 1.4 billion between book value and the market value would be known as the liquidation value. It is the actual amount, the actual value which you will be getting when you are really selling your company. All right, moving forward. In the next slide, I have kept some certain I have kept a few IPOs of Pakistan, a recent IPOs of Pakistan as an example. In Pakistan, these are some of the IPOs which took place and during last 3-4 years. For instance, the first one is mentioned as National Power Parks Management Limited Company. In 2021, they raised 3.7 billion rupees through IPO. In 2021, they raised to 3.7 billion rupees through their IPO. So they got this amount from public, from shareholders. Similarly, the second example, the Pakistan Stock Exchange back in 2020, they also went public, and they sold their shares on 6 billion rupees. So this was also through an IPO. Then TPL Tracker, they raised 1.4 billion rupees back in 2020. Then Organic Meat Company, they raised 907 million rupees in a IPO, in its IPO in October 2020. Then lastly, TPL Properties Limited, they also they also raised their IPO in June 2020, and they raised 2.2 billion rupees from public, from shareholders to an IPO. So I have put a few of these examples, the recent examples, just to give you as a reference. All you are obviously you are not supposed to memorize them. These are just to give you as a reference. Companies regularly generate financial resources through IPOs. All right. So the next thing, I am again stopping my recording over here. So this is the end of the part two of this recording. So see you back in part three. All right. Thank you.